Hi, welcome to Simple Wealth with Zoom podcast. I'm your host, Gakhar. Each week, I bring successful business owners and professionals simple financial security ideas to help you build and maintain your lifestyle and legacy. So, look for tax advice, accounting advice, legal advice, estate and investment advice that you can use to protect and grow your wealth. Today, I have Chuck with me, and Chuck is Regional Vice President for Insurance Distribution with Canada Life. And Chuck, he started in the insurance industry in 1998 as a financial security advisor at London Life. Wow, you don't even look that old, Chuck. And over the past 25 years, he has worked directly with advisors and their high net worth clients on their insurance plans. He strives to connect complex plannings to meet the needs and wants of today's demanding clients. I'm so excited to have Chuck with me today. It took me really long to have Chuck's time to be here and share his knowledge, his experience, his wisdom with you all. He comes with loads of knowledge, and I'm so excited that something which comes direct on the carrier side, somebody who deals with high net worth clients, is able to share for business owners and self-employed professionals. Welcome, Chuck, and thank you for coming.
Thank you, Sim. Thank you for having me. Happy to be
That's
here.
wonderful. Chuck, I'm going to ask you the questions which a lot of people have in their mind, and very especially my business owner clients, my self-employed professionals. And the question is very simple. Why is life insurance particularly interesting for business owners? Why?
Yeah, and that's a good question. And I think some of the answers that I hear sometimes start a little bit too deep. And what I try to really do first is connect with the business owner and understand what their goals are. And a lot of the goals are the same across every business owner. So basically, what are they looking for? They're trying to maximize income, revenue,
Yeah. Mm-hmm.
and trying to minimize expense. And when I say expense, I'm going to throw in there your expenses such as rent, salaries, etc., but also throw in tax. And tax is one of those expenses I give you no return. And I think that given the nature of life insurance, especially in the business owner environment and the corporate environment, you do have the ability to reduce, minimize, and potentially eliminate large chunks of tax. And I think that when business owners look at that as an opportunity, it's something that they naturally want to investigate.
Yeah, and isn't it so amazing that a lot of people think insurance is only for death benefit? And when they're business owners, they don't realize that insurance can do a lot. People know what insurance is, but a lot of times they don't know what insurance does.
Yes, and I think you captured that perfectly. When I talk about insurance, I think one of the ways that we need to be open to listening and learning all about it is get away from our initial preconceptions of it. I think whenever we use the word insurance, I think there is an association with car insurance or pure insurance, where you pay a fee so that if something happens, then you receive a payment. And I think when you get into insurance that specifically caters to business owners, it's not that kind of insurance, right? It's cash value insurance. And if I go a little bit further and I take away the regulatory boundaries when we discuss insurance, we get into exactly what you said. What does it do? It's less important to me what it is. And then we start with what your objectives are, what the insurance accomplishes, and you connect that conversation. But I don't find that's a very common way to talk about it.
Yeah.
Yeah.
Wonderful. I think he said in a very great way, just like you have a car insurance, you buy that insurance to protect you in case something happens to your car or something happens, a third party comes in and takes care of the liability. And for the life insurance, we do the same with the life. But for the business owners, there's something more it can do. It's not only talking about your life, it can do a lot more. So that's where Chuck told us today what it can do. Thank you, Chuck. That was wonderful. Now, we're moving on to the next question, which a lot of people really want to know. How do you explain how tax planning is achieved by using something as unintuitive as insurance products? Tax and insurance, two things. And I really, really want people to know that tax and insurance, there is something we can do about it. So Chuck, how do you think?
Yeah, so and it goes back to the initial idea of how insurance behaves in that corporate environment. One of the natures of insurance is that there is a tax-free nature to it, particularly upon death, but also in growth. Now, growth insurance, that's not necessarily connected by your average person, because where's the growth? really would be the question, because if it's insurance, why is it growing? And I think when people think about growth and insurance, they usually think buy term and invest the difference, right? Term is my risk and my assets grow. And I think one of the ways I look at cash value insurance is that cash value insurance is buy term and invest in the difference, but it's in a package. Now, the interesting thing about this package is that when you have insurance attached to the investment portion of it, the whole package becomes tax preferred. So this is the thing. What else do we do intuitively that we all do? Our principal residence accumulates tax-free. Right? TFSAs accumulate tax-free. RRSPs accumulate tax-free. So we're doing it already. But when we throw in insurance, sometimes, okay, this doesn't fit with the other three, but it does. So it just, and we have to get a little bit deeper into how does the insurance and the tax-free growth, the tax-free payout, how does that benefit the business owner in the end?
Wonderful. I think I love what Chuck said just now, is that there are only actually 4 tax-free vehicles that we have in Canada right now. Number 1, at present, your principal residence is tax-free. Number 2, lottery winning. Right now, you don't pay any tax on lottery winning. Number 3, TFSA, tax-free savings account. And number 4 is insurance. So business owners and professionals, when you're making that money, you want to keep it with you rather than paying it to the tax man, so you can get advantage of what Chuck said is using life insurance, which is going to be another tax-free way to grow your retained earnings and keep the money in the corporation but growing it. Great, great, great. Chuck, do you think that only applies to young people or older people? Or let me put it in a different way, this question for you. Why would a young business owner or an older business owner explore life insurance? Somebody's 70 or somebody is just 29 and making good money, or is a business owner or a startup? What do you think about that?
Yeah, so I look at life as a path from when you start your business to when you pass away. That is, of course, how we all take. And I think that a lot of business owners that execute with life insurance are doing it later in life because it's much more apparent to them what they need to do.
Absolutely.
Is that they've established now how much money do I need to spend? How much money do I have left over that is my discretion? Basically, if I do nothing with it, how much do I lose? How much do I pass? And when we start to quantify how much money they could possibly lose by inaction, or not completing the action, because what a lot of older clients will do, they'll do a lot of tax planning, they'll talk to their accountants, talk to the lawyers, but they don't talk to the insurance advisor necessarily, which when you plug in insurance solutions, it actually enhances the other planning that you've done. Mm-hmm. And I feel like that it's much clearer for them, because again, when your time horizon is shorter, it's much easier to quantify what you need and what you want to pass. Now, what we sometimes forget is that they, in order to get here, they pass through the young person's time in life. Yeah. And that's when you started the business. And when you started the business, where insurance fits is, what are some of the things that are always common? When you inject capital to grow and build your business, it's not necessarily liquid. And one of the things that you need to do is you want to provide a provision that if there is a premature death, that your locked in money, let's say, can come back out to your family. Mm-hmm. And usually people use term insurance, and that's fine. Yeah. And because if you need large sums of insurance, term insurance will give it to you cheap. However, if you want to kind of consider the long time horizon, and what you can say is, well, I don't want to pay all my premium for term insurance. I want to allocate a portion of it into an asset which grows. The same idea of buying term, investing the difference. Yeah. So what I do is I take a portion of my insurance need and I fulfill some of that requirement using some permanent insurance. And then as I fast forward through life and I get to the point where now I'm older and my time horizon now is shorter, I've already dealt with what some of the people who are doing later in life are about to do. So it's really a journey.
Absolutely.
Right? It's a journey, and it depends when you engage in the conversation, when you get exposure to these planning ideas. That I think always the sooner is better. With any kind of investment, the compound nature, even with relationships, the longer you know a person, the deeper it goes. And I think that you have to start this planning earlier because then you can get it. Because when we talk about insurance planning, one of the key obstacles is, am I now insurable?
That's the main thing I was going to come to.
Yeah.
Absolutely.
Yeah.
You so rightly said. If you're waiting that you're going to build those assets and then you're going to take that insurance when you're going to be in your 65 years old, 70 years old, at that particular time, if you think that you might not be insurable at that time, because to get the advantage of what insurance does, as we discussed, Chuck, you have to be insurable, you have to get medically approved. And when you're younger, the chances are that you are healthier, you're more insurable, you can get the best rates for the insurance. And as Chuck mentioned, that the cash value insurance policy, as you are growing your portfolio, as your business is growing, so is the cash value in the policy growing. Am I right, Chuck? Because in the cash value policy, the cash value is growing tax free as well. And then I think you are building two assets.
Mm-hmm. No, you're building your business asset. You're building, well, you know what, when I think to think about the insurance asset, sometimes people think I either have it or don't have it.
Yeah.
I think that we need to look at insurance through the lens of investments. It's like if I have investments, I can always add to it.
Yeah.
I can create additional portfolios. And insurance, it's the same. So I mean, it's kind of a workaround of what you had mentioned, but I just wanted to add to the idea. I think one of the easiest ways to think about the insurance is think about it like an asset. And I did notice when you were saying, when you're in your 70s, and I find a lot of people think that when I'm in my 70s, insurance isn't a solution for me anymore.
Yeah.
They think I'm too old.
We hear that. Yeah.
However, when those are actually if you are insurable, those are the best, that's the best demographic, right? Because then we go back to the whole idea of my time horizon is shorter. I already know what I'm doing with my assets. And if you're insurable, absolutely do it. And I didn't touch on this when I started, from your first question, but I think we really need to quantify the tax rates to people so they understand them. Now, the final tax rate is important because if I pay one tax and I don't consider the second tax or all taxes, I don't actually know what the damage is. And I think and I always tell people, just in a nutshell, your highest marginal tax rate in Ontario on a personal basis is 53.5.
Yeah.
People think that they pay less tax when they incorporate, and that's only half true because they paid less tax up front. The final tax, when you add up all the taxes, it's actually higher than a marginal tax rate personally. And it's probably closer to 54%.
Yeah.
And if you talk about investment income tax, the flow-through rate is closer to 58%. So it's very punitive. It's one of those things that if the business owner understands what the tax impact is, then I think that would motivate you to respond. And that's exactly what we saw actually back in 2015. Mm-hmm. When tax rates went up.
Yeah.
We saw an influx of insurance planning because now people said, you know what, now it's too high. Anyway, a little bit of a kind of sidestep on the question. Not a sidestep, but just I want to cover a wider topic on that.
Mm-hmm. No, very rightly said, Chuck. I love how you said that. The people think that when they're in the corporation, when they're in the business, the tax rate is low, and they think that it's all done. The planning is done. It's actually not done unless they do a proper planning, because positioning insurance, there are a lot of things they can do. And please don't think if you're 70 or you're 75, you can't buy insurance. You can still get it if you're insurable, but it's always advisable to get it as you're growing. Get it in the game early, because you're growing, your business is growing, and then you have a policy which is growing as well, because insurance in the corporation, if it is a cash value insurance, it's an asset to your business. So that's a great way. That's wonderful. But I want to discuss one more thing with you, Chuck. As you said, that as a cash value insurance, a lot of time people think there's a perception that deposits made into the life insurance are locked in. They feel, oh my God, I paid the money into the policy, I can't take it out. So what do you say about that?
I say that I go back to the analogy that if you think about the policy like an investment portfolio, then you have a much stronger understanding of it. And I think that association, when people think I put it in, I can't touch it, I think that goes back to pure insurance again. Right?
Yeah.
If we go back to the whole notion, buy term, invest the difference, well, if there's an investment component to it, that money you can withdraw. Mm-hmm. I know that sometimes for people who have just maybe been slightly exposed to the insurance conversation, there's a lot of talk about borrowing.
Yeah.
And some people, when they spend their entire life getting out of debt, they don't necessarily want to go into debt when they're older. And for those people, you can always withdraw the money. Mm-hmm. It's just not often discussed. And there's some technical points around it, which is why I would engage an expert. Mm-hmm. However, money that you put into the policy, you can get back out using a number of ways. Number one, the first way is you can withdraw it.
Yeah.
There could be a tax consequence. Number two, you can use a contractual policy loan, mm-hmm. which is basically you can instruct the insurance company to give me a loan against the value of my policy, no questions asked.
Yeah.
right? It doesn't matter what no one underwrites it. So basically, it's literally an instruction, right? Give me my money, they have to give you money. And the third, which has become more and more popular, which a lot of business owners will already understand, is I can use my policy as collateral for a third-party loan. Now, the reason insurance is preferred often than using other assets as collateral is because the loan ratios you can get in an insurance policy are typically very high. Right, and we're talking somewhere 90 to 100% depending on the circumstances, and the execution of the loan is quick because it's very easy to underwrite the asset. So business owners know there's certain things that banks don't like, and there's certain things that they do. Right, cash or near cash is always good, and I feel like life insurance is heading towards closer to the category of near cash than almost anything else.
Very rightly said. So what Chuck said right now is that there are three ways you can take the money from your policy. Number one, you can take it as a cash withdrawal. You can withdraw the money from your policy, and then there's some tax consequences, as he mentioned. Number two is that you can take it as a policy loan. Policy loan means you're loaning the money from the insurance company. Am I right, Chuck?
Absolutely.
And number three is that you are using your policy as a collateral and you're taking the money from third party. You can go to any bank, top 5 banks, or even credit unions or any lenders, and they love these policies because these policies have very high collateral capacity, and you take that money. So the perception that everyone has that the money is locked in is actually not. You have different ways to take out the money depending upon the need, depending upon the time. It's not that you have to take the money in the first year or second year. We've seen clients paying the premium into the policy, Chuck, and they want business owners, they have cash value, and then they have a need for investment somewhere else. They borrow immediately after they've paid the premium, just like an IFA. So the third thing that I said, collateral capacity, you can borrow it from the third party, can be done. Am I correct?
Yeah, absolutely. So, and to the point of the IFA, which is the immediate financing arrangements that we're seeing in the marketplace quite a bit, it fits right in line with the business owner need. So, wealthy business owners, they may have estate tax liabilities in the millions.
Yeah.
And in order to fund millions of dollars of tax liabilities, you would have to think intuitively, if I had to invest it in a portfolio, there would be big deposits.
Yeah.
However, business owners usually don't have a dollar lying around doing nothing.
Yeah, that's why they're business owners.
That's why they're business owners. They're always growing their assets. So if you say to them, well, you need to set aside, let's say, a few $100,000 a year in order to fund this final tax liability, they may say to you, I can do this, but I can't do it today. I might not even be able to do this year or even next year. But give me 5 years, I will be good. So what some of these financing arrangements do is that they give them the provision to put the money into the insurance solution, use it as collateral, get the money back out so they can redeploy it in their business. So now they have two projects going. My estate project and my business project, which is what got me here. I will not stop doing this. And then, like you say, 5 years later, they may say that, you know what, I've gotten used to the outlay. I can now just take out the loan. So now this will be paid for, and then my business will run as it is. That's whole intent. I mean, that's the flexibility. Because what often stops business owners from implementing insurance solutions is that they don't have the money today.
They don't have the money today.
And so they don't go. And do they have it next year? They don't go because they didn't arrange to have it.
Yeah.
But if you start it and you put it in and you do that financing, now you arrange around that.
Yeah.
Right. Yeah. So the execution is important, and I think that understanding what they're getting out of it is important, and enabling the business owner to continue with their business is key. They will not stop doing their business because that's what their passion is, and that's why we're talking to them. That's where they build their wealth.
And what I think is that when they borrow the money, when they pay the premium and they borrow the money comes back in their hand and they're paying interest. Interest payments are much smaller than the whole premium that is going from their pocket. So it becomes a very good way for them to take care of their estate planning purposes as well as they've done a very good insurance planning. So that brings another question to me, Chuck, which I think a lot of people want to know, that difference between insurance planning and estate planning. Let me put my question differently. Not the difference, how insurance planning can help estate planning.
Yeah, so I mean, if you want to accomplish a larger goal, which estate planning is, it's multifaceted. There's a lot of things that you have to deal with. It's not that it's done or not done. It's how well was it done. And I think a lot of people say to me that my accountant's got it covered.
Yes.
Right? And that happens a lot.
All the time, yeah.
Right, and as an accountant, the accountant will tell you, I've got it covered. And yes, they've covered as far as their scope is, but as I said, it is multifaceted. It's much larger scope. And one of the things that people don't often get to see is what happens if you do any one piece in isolation. If I do just insurance planning, I will get a result. If I integrate that result with the accounting, it'll be a larger result. And the same way goes the other way. If I count result will be this big, if I implement this, it'll actually enhance it. It's kind of like, if I want to use a real life analogy, it's like a house or a car that you buy. When you add stuff to it, it performs better.
Yeah.
And it's not intuitive, and that's why I think you need to work with multiple advisors that know how to work together. Because you can talk to them in isolation, the job doesn't get done as well as if you integrate that conversation. So I feel like that's something that needs to happen more often, but traditionally, our accountants working with insurance planners, they're not. This is still relatively new, and I think it's one of those things that we need to push more mainstream because the results are that much better.
Yeah. And you deal with that all the time, because I know you work with so many advisors. You in fact help advisors sit in front of their high net worth clients with their accountants, and you help them understand how to put these things together in the favor of them, and how they can grow their wealth and how they can pass more wealth to the next generation.
Absolutely.
Wonderful. But the question comes that everything has pros and cons.
Yes.
You know that.
Yes.
So let everyone know a little bit more about what are the cons. You can say, I know we've heard a lot of pros, but is there any cons?
Yeah, so when I think about the cons of insurance, I think about, it's not so much a con as so much what will restrict me to do it, right? And I usually think on three lines. Number one, I'm not insurable. If this is a time-sensitive, circumstance-related thing where everything kind of has to line up with my health. I might have the money,
Yeah.
right? But I need to have the health as well.
And I've come across that many times. People come to me and they say, I'm going to have 7 million or 8 million or even 1 million tax liability on death. I don't want my family cottage. I don't want my house to be sold to take care of that. I want to get insurance. And we go through the whole thing. And in the end, they're declined.
Yes.
And there's nothing they can do at that time, because insurance is not something like you're going to the bank and putting the money in your account. Insurance is something where you have to qualify. And when there's no medical underwrite, when you're not medically approved, then you can't even implement.
Yeah. So that's
number one.
That's number one, and in no particular order. But number two is, do you have the money?
Yeah.
There's no
Money.
conversation if you don't have the assets. But I think that the more money you have, because tax is applied on a percentage basis,
Yeah.
the more money you have, the more of your money is at risk. So that's one thing. But if you don't have the money, there's no conversation.
Yeah.
Yeah. And then the last one is the money that you need to commit to the solution. Do you need all of it? Right.
Yeah.
And that used to shut down a lot of cases, but we're finding more and more now, and there's a lot of provisions now to get the money back out. Right. If you can't access those provisions, you can get the money back. But usually it's those three things I can think of. Right. It's do you have money? Can you execute the insurance solution, and the money that you commit into it? Do you need all of it? Do you have a way to get back to it if you have to? Now, even the products today are designed that you can get back to your money. There used to be that insurance policies had very low cash value early.
Yes.
Right. So basically, your money is in a way locked in because you don't have access to it. But I think as the products have evolved over the years, the cash values from year one are very high compared to your initial deposit. Now that gives you options now. Right? Do you withdraw some money back out? Do you loan it contractually from the insurance company, or do you go to a third party and you get a loan against that? So I think a lot of those things you can get around. Do you have the money? That's kind of up to you. Do you have the ability to make it? Have you made it? Do you have a provision to get the money out? The one that's kind of out of our control is, can you get the insurance?
Can you get the insurance?
Yeah, that's one that's out of our control. So, these are the things, and I think if I had to go stretch, what is another, I think, con or restriction is sometimes the explanation on these insurance solutions are so complex, I don't understand what you're talking about. And I think most people don't do it because the message hasn't been properly conveyed. What is the value to me?
Yes.
And when I understand that, I'm motivated to do it. And if you look at this parallels with everything else you do in life, if you don't know what you're doing, you generally don't go. Right? So now it's finding the right advisor, communicate to me, tell me what this does for me. And it goes back to what we touched on, right? It's not what it is, it's what it does.
What it does, absolutely. And you know what, Chuck, that is where something a lot of people are always lost. They're not very sure. They don't know whether they should get it or not. They don't know whether it is the right product for them. And positioning it is the main thing. And the right timing, as you said, money, health, all these things have to be in your favor when you're getting this all. So this has been a great conversation for the viewers, but I would also like you to tell them a little bit about if a young person is starting a business and the person is, let's say, in their early 30s and they do not have too much money to put in, would you suggest them to get a life insurance with cash value, or you think what they can do right now is get a term policy, and as the business grow they can convert it into a whole life policy and get the benefit of everything? This way they preserve, they secure their insurability as well. A little bit about those, because I've got so many clients who are doctors, who just are lawyers, they just came out of the med school or law school, and they're starting. They know they're going to make a lot of money, but they don't have that much money right now.
Yes.
So what do you suggest about that?
Yeah, so that's a great question. So what I generally see in practice is that when you enter into, I guess when we talk about a doctor, they've invested a lot of their time, a lot of their human, sort of their own human resource, and in order to protect that, insurance, like you said, there's not enough monetary resource.
Yeah.
So what you want to do is get as much insurance as possible for as cheap as possible, which is usually term.
Yeah.
Now, we ask the question, okay, so now that we've got term, what happens if as I accumulate assets, now I have an opportunity? Because when you start contributing to TFSAs, RSPs, that means you have more money.
Yeah.
Right? And doctors, they don't necessarily do RSPs because of the corporation. There's all kinds of variables. But getting back to the insurance, when I have the initial term insurance, that gives me a provision that's called a conversion privilege.
Yeah.
Conversion privilege. And what that basically means is if I take out $2 million of term insurance and I decide later, now I want to start saving and using the tax benefits of the insurance, then what happens is the insurance company will take the coverage that you've already acquired and you can change it into a policy type that will accept cash deposits. Going back to the whole idea of buying term, investing the difference, is when you buy term and you're ready to invest the difference, you can use this policy now to accept money to grow in that tax preferred environment. So it's one of those things, we go back to the whole journey of life. You started early, your circumstances change along the way, and I think what ends up happening is people usually are pursuing money or wealth from the start, and when you've achieved it, now the next stage is to preserve it.
It's to preserve it.
Right, and that's when you get into the idea of, I've got savings now, I want to preserve as much as possible, I want to lose as little to tax as possible. That's when you start looking for provisions like TFSAs. Do I want to invest in tax preferred instruments? And insurance is one of them. And term lets you do that because the option to make it permanent is actually in the contract.
Yes.
Yeah, this goes back to carrier selection as well, right? Now you have to figure out, okay, do I use the insurance that I get on my credit card? They say you can buy insurance. Yeah. I'm going to say no, because that is a dead-end product.
Yeah, that's not convertible. Yeah.
Right, and it's not usually the cheapest, right? And it's not portable. Yeah. So if your circumstances change, you change whatever provider, then it's done. Whereas if you go to a direct to a carrier, then you can move around different jobs, right? Yeah. And it's once it's in, and you maintain the option to convert, but you want to be with a carrier that's going to give you good conversion options.
Wonderful. I think that's very rightly said by you, Chuck, that even if you're young and you're just a med school graduate or any other professional school graduate, you're an engineer, you just started working and you don't have that kind of money to put into a whole life policy, but one day you will make that kind of money, and you want to really right now, you want to make sure that your insurability gets locked in, because when you do the conversion of your term policy later on, right now term is cheaper, but eventually you'll convert it into a permanent policy. At that time, no health questions will be asked. Simply just by signing a conversion form, you'll be able to get the whole life policy. No medical questions will be asked. And the best part will be, at that particular time, you don't have to convert it all at once. You can do it gradually as you grow. You can take bits and pieces and start converting into a permanent policy. And that takes care of the whole thing. That was wonderful. I think that relates to everybody. You don't have to wait till age 70 or age 75. If you are age 70 or 75, good, if you're insurable. Otherwise, when you're starting, so that covers everyone. This is wonderful, Chuck. I really, really thank you for coming here, Chuck. You've shared so much information here, and as I say that, this is so informative. It's not only for the viewers, even for me, I feel that I've learned so much here from you, and I always learn. Whenever we meet, I learn so much, and that's the reason I really, really wanted you to be in front of everyone and share what you have to. So I would say that in case anybody wants to be in touch with you, the best way to be in touch with you, I guess, is through me, or do you think?
It will be through you.
That's right. I know. I'm the lucky one. And that was another episode of Simple Wealth Wisdom Podcast. Watch for us again next week with a new guest, somebody like Chuck, somebody who knows the industry, somebody who knows how to deal with, how to help using insurance, business owners, and professionals. Until next time, I'm Sim Gakhar. Take care, stay safe. Thank you. Thank you so much, Chuck, once again.
Thank you, sir.